Hi everybody, welcome back to my channel. My name is Yasin Nizami and I make these videos to educate my audience like yourself about the real estate market in Canada, particularly in the GTA market. But I also cover some macro factors, some geopolitical situations, some investing strategies. So if you are familiar or interested in these topics, consider subscribe, like, and share with your friends and family. Let's get into today's topic. Today's topic is again post analysis of the Bank of Canada's last rate hike, and I made another video right after that news where I covered and explained to my audience how this was the biggest rug pull by the central planners and pushed Canadian towards more economic pains. I understand that the rates were very low for quite some time, and they were not supposed to be that level forever, but the debt level has been so significant and it has climbed up to the new records. You can understand, a 1% rate hike will make people's life more miserable because the amount of debt they have taken in the last 2 years has been astronomical. Yes, I understand it was consumers' own decision, but think about that. The monetary policy that Bank of Canada or any central bank has been running for the last 2 years, or even if you go back beyond pandemic time, this was built to push people against the risk curve. When you have the bond market yielding 0.25% return on their investment, and you have GICs like saving instruments, yielding 0.6%, like less than 1%. If you keep your money in the savings account in your bank, if you're getting 0.8, 0.7% return, then you have no other choice rather than keeping your money in the bank. You would go and buy some riskier assets like crypto and like real estate in the most bull market ever we have seen in Canada. So when your country's monetary policy is designed to push people towards the risk curve, you cannot expect any other result than what we are seeing right now. So the people took risk because they had no other choice. They had no other choice but to go and buy riskier assets. Now what we are seeing that this is the biggest rug pull when the central planners and central bankers have been raising interest rate across the globe. It's not just Canada. We are seeing in US, we are seeing in England, we are seeing in Australia, New Zealand, Japan. Japan has been a laggard in that case, but most of those Western countries have been working in full unison. And I think one of the reasons why they were forced to do that is because US has been increasing rates aggressively, and because of the interest rate differential, the other countries are supposed or are forced to raise their interest rate as well, because if they don't follow, then their currency will get depreciated against US dollar, which we have been seeing. All the major currencies have been depreciating already, but then the damage would have been even worse if they didn't increase the interest rate. And what I wanted to share with you is this is basically the poor management from our federal government. When you have the federal government of the country running fiscal deficits like $325 billion for the emergency pandemic recovery, you don't expect other than what we are seeing right now. So if I share my screen right now with you, you can see this article from National Post, and they talk about how Canadian federal government has lost $32 billion, 32 billion for B, under the pandemic payments that they have paid across the country. A lot of this payment has gone to the people who were not qualified to begin with, and then around 4.5 billion has been lost. They don't know where it went actually. So this is the level of utter incompetence and the mismanagement of resources and malinvestment. If you understand the economic terms, misallocation of resources and malinvestment is basically when you handle your taxpayer money, your resources, and spend on unproductive assets. This is what you get. So further, if you go down, you can see the amount of money is so big, it's so big that if we were building the Canadian Pacific Railroad in today's time, we could have done this 18 times. 18 times. That's the amount of, money that we are talking about. And the era where Canadian Pacific Railroad was built was considered the most corrupt times in Canadian history. Even then, we would not have spent that much money what we did in the last 2 years. So that actually gives you a sense, in terms of how irresponsible government fiscal policy has been, along with the monetary policy, because all of that debt was financed by Bank of Canada. So when Pierre Poilievre criticizes Bank of Canada's governor, he's not, talking BS. He's telling the truth. I'm not a political person, but I'm highlighting the facts right now, that the mess we are dealing with right now in front of our eyes is a direct result of government fiscal and monetary policy by Bank of Canada. You cannot print money out of thin air and expect no inflation in the consumer economy. It doesn't happen like this. And typically, the monetary policy takes time to show the real impact in the consumer economy, because the asset markets like stocks, like real estate, which are sensitive based upon the interest rate fluctuations, you see the impact of the monetary policy immediately. So when the monetary policy was very loose, interest rate went down and QE engine pumps up, then we saw the asset market starts, climbing up. Stocks up, crypto up, real estate up, right? But we did not see the consumer inflation until almost a year after. So when March 2020 when the COVID was hit, monetary policy kind of changed. Everything was down to zero, QE pumped, and then we saw asset classes immediately climbed up. But we did not see the inflation in the consumer economy until like mid of 2021. So similarly, when the policy is reversed, now it is being tightened, we will not see the real impact until mid of 2023. And this is what David Rosenberg is talking about, that we haven't seen the worst yet in terms of consumer economy. We will see this next year when the inflation kind of climbs down, but the recession will kick in, because all we are seeing right now is the stats showing that the consumer economy is contracting. Record amount of job losses from the tech sector. We are seeing the lenders are laying off people who were related to the residential real estate market, because the market is almost collapsed. And when these people became jobless and they don't have enough income to pay off their debt, which is climbing up as a result of the interest rate hikes, this is where the disaster is being making, right, guys? So keep in mind, the 2023 is going to be another challenging year. And yes, Bank of Canada might take a pause here. That doesn't mean that they will drop the rates down to 2% again. In my opinion, the rates will stay here until the recession, the inflation comes down, maybe 3%, maybe 2.5%, and then they will start reducing the rates. But they have to make sure that inflation is not sticking and the economy is really contracting. This will force them to reduce the rates. Until then, we don't see the rates are coming down. And no, this is not a bullish signal for real estate market. Real estate, I think, has gone to the peak, and now it is kind of being normalized, and it will not go up to that level for quite some time, because the environment is not there. It was the free money, almost free money, that was being pumped into the real estate market, and the sentiment from the buyer, like the current buyers in the market, they did not see the last recession in their lifetimes. Most of them were immigrants, came from different countries like myself. They thought real estate will always go up. And the reason why they were buying like crazy is because they had the assumption that, okay, even if I'm paying $200,000 more, I will make $400,000 in the next 2 years. That's a big deal. That's a good deal. So that's what driving it. Now people are realizing, oh, it's not what we thought. So now things are kind of being normalized. So anyway, this is just my thoughts that I'm sharing with you, there are still buyers buying it right now, but the inventory is not there. I think when the spring market hits, then we will see a lot of inventory coming into the market. Then we'll see the price pressure will continue going down, because right now the inventory is still tight. We don't have enough choices available, but the genuine buyers are still out there trying to buy the house because they want to live in those properties, not for flipping, not for as an investment, but they want to live into those properties. So that's it for me this week. I hope you like it. Give me a thumbs up if you like it, share it, and subscribe to my channel, and I'll see you in my next week video. Take care.